The whole market is waiting with bated breath for NVIDIA earnings, which are going to be coming out this afternoon, but we haven't gotten them yet. The other earnings we've gotten so far are pretty good, but that's the one, obviously, that everyone is biting their lip about. However, there are other things in the economy other than just NVIDIA and AI, including commodities and what they may signal. We're going to talk a little bit about that today on Open Interest. Hello everybody and welcome. I'm Mike Coe. Welcome to Open Mic. Well, of course, NVIDIA representing, as it does, about 6.5% of all of the major indices is really the thing that everybody is waiting for. With a more than 10% implied move and results expected any minute, it's going to move the market if it moves at all, simply because it is such a meaningful constituent. However, I think that we might want to think about the economy a little bit more broadly than just NVIDIA and just AI, because one of the things I noticed today was that energies were performing pretty badly. Helmerich and Payne, for example, I think that thing hit a 52-week low. The oil service companies, Schlumberger and Halliburton, also looked like they had been hit pretty hard, but that wasn't really the commodity. It wasn't oil so much that I was interested in. What I also was thinking about as I was looking at that was the relationship between copper and gold prices. So before we get to some questions, which I hope to take a few of, and maybe we can work through some upcoming events together and try to figure out what's going on, this is basically the performance of copper and gold year to date. Now, those of you who follow me on CNBC, if and when I'm on at the beginning of the year, most of the folks that are contributors to Fast Money are asked to provide an acronym. And that acronym is supposed to sort of represent your best ideas for the year. And one of those for me, my acronym was BRAVE. The A actually stood for gold because I was talking about the periodic symbol for it, AU, something that Tim Seymour took issue with because it just happened to make a nicer acronym as far as I was concerned. So that was the reason I did it that way. And of course, gold has performed very well. But what's interesting to me is that lately, even as gold has continued to rise, and it obviously came off a little bit, I think it was down about 11 bucks an ounce today, copper prices really have not been performing very well at all since about mid-May. So if you're looking at this chart, this is the differential down here on the bottom. Why don't we just take a look at, so this is in white, we're looking at copper, and in yellow or orange, appropriately enough, we're looking at gold. I guess that actually probably is closer to the color of copper. We could have chosen different colors if we wanted to, but it would be a little bit harder to distinguish these two lines. But one of the things we can see here is that clearly, and I'm normalizing this, we can see this is the spread. So for the beginning of the year, obviously some volatility fluctuating around, but in terms of the percentage change through mid-April, they were effectively neck and neck. From mid-April to mid-May, copper materially outperformed. But since that time, it has massively underperformed. Right? So we're looking at a difference of about, underperformance now since then of about 23%. And why do I care about something like that? Well, copper's use is obviously important in electronics. It is important for things like plumbing and housing supply, wiring. And so we would generally expect copper to do well if we expect the economy to be doing well. It's not as much, we're not looking at, there are multiples of industrial metals that we could be considering. We could be looking at rolled steel. There's a couple different things we could be looking at. But, the copper-gold relationship is one that a lot of people like to focus on. And it occurred to me that this is a little bit troublesome. And you combine that with the fact that the market seems to be holding all of its hopes on names like NVIDIA, and you begin to suspect that the market is effectively, riding on NVIDIA's back a little bit. And I think that's a dangerous predicament. So I've brought it up before that I thought volatility, when we saw the VIX close at 1470 that Friday, that maybe it would make sense to buy a package that would allow you to realize volatility. For those that didn't check out that live stream, what we talked about was buying a strangle in, SPX or SPY, maybe buying a 25-30 delta call and put together, and then hedging those periodically delta neutral. So you could hedge it once a day, or you could potentially sometimes even hedge it more frequently than that if you chose. But the idea is that you are buying the current implied volatility, and then the profits will come if realized volatility was going to exceed that. The difficulty that we have now is that, of course, volatility has crept back up. Not a huge amount, but it is higher. So we can just take a quick peek here and see where the VIX is. And by the way, the next thing I think might be interesting to take a look at is the implied volatility that we're seeing in SPX through the election. I don't have a prediction, so we closed over 17. Why don't we just pull this up so we get a little bit of historical context about where that is. And we're going to draw a line on here so we can sort of see what that represents. There we go. So that's effectively where we are right now, 1711, and you can see that that is certainly higher, well above the median. Is it above the mean? Well, that's a different thing, of course. When volatility is involved, I sometimes talk about the mean and median. I shouldn't interchange these things, though, because one of the things that's important to understand is it's a mean reverting process, and there is an effective floor to how low implied volatility gets. But when it spikes, it can really get up there, and that's going to throw off the average. I think the analogy that I had made once before is you can imagine you're in a bar with 10 people. Bill Gates walks in, and you start trying to calculate the average net worth, and you basically throw it all off. Not quite the same thing. The VIX getting to even 80 isn't exactly like Bill Gates in the bar, but it's kind of an argument ad absurdum, sort of to make the point. That said, this isn't quite the level where I would think about selling it yet either. So for those of you who may have, and I know at least one viewer is at the very least paper trading that, or was, and Brad, if you are listening and you are still following that trade, maybe you can just post into the comments how that is looking for you so far, if you have continued to do that. So I think that's kind of interesting. Now, one other thing I'm going to point out is that I believe Brad actually asked a question here. And there it is. Okay. How do options markets reflect the likelihood of multiple interest rate cuts by central banks, such as the Fed? Do they work off of others like ECB and BOJ announcements? Okay. So I think this is, first of all, interest rates are indeed very important to the value of options. Now, it's going to be harder to tell in many cases if you are looking at, say, single stock options, even more so if you're looking at single stock options that pay material dividends or where dividends may be expected to change. The most effective place where you can see what the implied rates are for within the options market is going to be in SPX. And so if we look at SPX options, it's not uncommon for options traders to actually trade rates by trading boxes. So if any of you are familiar, then I might be boring you a little bit, but let me just explain what a box is and how it is used when you're trying to think about rates in the options market. So a box is very simply the purchase of one synthetic and the sale of another of the same expiration. So let's provide an example, and maybe I'll just go out to December. So this is going to be a little bit of options 101 here, which I think might be useful, or oops, why am I in VIX? I should not be. These trade pretty commonly in SPX, and it's a product that's most often, it's a trade that's usually done by institutions, and it's particularly self-clearing institutions. So when I was at Cantor, we were self-clearing, and the reason is that the way it works, if you are a self-clearing member of the OCC, you have a risk-based haircut margin that you have to post as a function of your positions. However, whatever that is, you always have to post your net long premium. So to put things in perspective, if I buy a lot of premium, even if it's very low risk, I still have to post it. And consequently, self-clearing members, therefore, don't like to carry huge amounts of premium if they don't have to, because it may give you a margin requirement or a haircut that is unrelated to the amount of risk you're actually facing. So a simple way to offload some of that premium is to do a fairly riskless trade that's going to embed the cost of carry, and that trade is a box. So the way that works is if you're buying the box, you could, let's just say, buy the 5250 calls, the December 31st 5250 calls. Actually, you know what? I don't know that I can use I'd love to build this into options play because I think it's going to illustrate it a little bit better. But since it's not ideally suited for index, I'm going to do it using SPY. So we understand what a box is. We understand how options traders do it. Just understand that they would not normally do it in something like SPY. What does SPX have that SPY doesn't? It does not issue a dividend. It's cash settled, and it's European, right? So when you trade the structure I'm about to outline using SPY as an example, when you do it trading SPX, it effectively becomes the functional equivalent of a zero coupon bond. So let's just take a quick peek at what something like that might look like. And then we can sort of think a little bit about the rates picture. So what would happen is you're going to buy one call, sell one call, buy one put, sell one put. You're going to buy a call and sell a put of the same strike and expiration, and then you're going to do the exact opposite at a higher strike and expiration if you're buying the box and the inverse. So let's just do this. I'm going to buy the 525 calls. I'm going to sell the 525 puts. And then I'm going to buy the 575 puts and sell the 575 calls. So notice if you're buying the box, what's going on here. What you're doing is you are buying the two in the money options, the 525 calls and the 575 puts. And you are selling the two out of the money options, the 525 puts and the 575 calls. So when you trade a synthetic, so buy call, sell put, you're in a way sort of buying a forward on the underlying instrument, because one way or the other you're going to buy the underlying. Because if, for example, I buy the 525 call, sell the 525 put, if the underlying is above 525 at expiration, then the call gets exercised, the call that I own gets exercised, and I acquire the underlying at 525. If I'm short the put and the underlying's below the strike of 525, then I will be assigned on the put, and I'll end up owning the underlying at 525. So the same thing happens regardless of where the underlying is. So the effective cost of the forward is that strike plus however much premium I spend for it. Well, in this case, I'm doing that synthetic on the 525 strike, and I'm doing it on the 575 strike. And the difference, so that in the case of an SPX box, for example, that is $50 apart, so the multiplier is 100, or actually it's going to be $500 apart in there. So it's going to be 500 times the multiplier is $50,000 per box. So if I buy the structure, essentially I'm lending to the market, and whoever sells it is borrowing from the market, and the difference is going to be essentially, think of it as where a zero coupon bond trades. Okay, so what that means is that when you take a look at options prices and you are trying to just guess what the forward is, you'll notice, I don't know if you can see this very well. Let me see if I can, if we can just blow up, I don't know how much we can expand this, but I just want to just show this the stuff that's right down here. What this is showing you is the implied forwards, the implied dividend, and the rate assumption. So for example, you can see that the rate assumption from now until January of 2025 is 5.11%. And if I pick a nearer dated expiration, it's going to be higher. So we can just look out to the end of September, for example. Let me see what the options market's implied rate. Here it's 5.25. Makes sense, right? Because short-term rates are what are going to guide the interest rates that affect options. Now the thing is, if you say, okay, well, does that mean I can go and take a look at, for example, next June options, and I can back out how much the carry is by sort of calculating that zero coupon bond and saying, okay, is that going to tell me what that rate is? Well, not exactly, and why not? So here you can see that the implied rate for the June 30 SPX options is about 4.6%. So does that mean that the options market is implying that rates are going to be 4.6% next June? No. What that's implying is that the average rate effectively between now and June expiration, so the effective rate over that entire window of time is 4.6. And since it's currently 5.25, I could logically deduce that the forward rate is actually going to be lower. So it's a function of how low are rates going to go and at what point are they going to drop. And the fact is that going to the options market, you're going to find that these rates, if you actually did all the work and did all the math, what you're going to find out is that they pretty much line up with rate futures. So commonly, it's not uncommon, I would say, for folks to take a look. There's two markets, I think, that were really common. So everybody used to use LIBOR, or a lot of folks used to use LIBOR. LIBOR, obviously, due to the sort of the fixing scandal. We've gotten rid of LIBOR, and now we have SOFR. So I think if you look at SOFR futures, you have a decent idea. But the fact is that the rate markets are quite efficient. So I think it probably makes as much sense. And oh, by the way, if you can see the screen, there's got to be a way to blow this up, but I'm going to rely on the people who are driving things behind the scenes to make it possible. I'm going to simply highlight this number. But I just want to go out here and say, look out to six months for U.S. Treasury bills and look at these effective rates. And what you're going to see is that by and large, these things are going to line up pretty well with what you see in the options markets. And these things trade tight. So if you take on a lot of one-sided trades where you're getting long a lot of row, which is your interest or carry cost exposure, or short a lot, you should care about rates simply because it's a risk you're taking. But if you're interested in trading rates, and unless you're self-clearing and you therefore have a lot of risk associated with being long premium or something like that, it's a good question, Brad, but I don't know that it's necessarily something you guys need to concern yourselves with too much. Where they'll be interesting, though, is that just look at the risk-free rates when you're trying to do things like back out how much a dividend is implied to be or something like that. And just make sure you have that piece of it right. And then if you can't get things to line up with the dividends and the risk-free rates, you might want to take a look and find out whether the underlying is hard to borrow, because that's going to throw up the rate picture into all kinds of a big mess. You'll usually start to see option spreads widen out in that case as well, because options traders don't necessarily, they're not going to sit there and make a tight spot market on borrowing the stock if they think it might not be GC, good general collateral, whatever. Okay, so let's see. All right, NVIDIA is larger than the entire energy sector. Your thoughts? Okay. Yeah, NVIDIA is larger than, so many things, isn't it? So that's definitely a problem. I don't like the fact that it is so much of publicly traded equities. I don't like that it is bigger than all of these other industries. But it's interesting too, because consider that Warren Buffett has been, number one, accumulating cash. So Berkshire Hathaway, I think they cleared $1 trillion today. Did I see that? Let's just double check. But I'm pretty sure I saw that cross the wire. So let's see. Yep. So there we are. It's up 1%, and it's $1.001 trillion market cap. So that's interesting. But what is also interesting to me is that he has been pairing positions like Apple, which is not even quite the high flyer that, say, NVIDIA is. And what I think is more interesting is, take a look at this number. I don't know if you can make that out, but what that number is that I'm highlighting right here, there, I can zoom this in a little bit. Let's just take a good look at that for a second. There we go. Right here, cash and equivalents. That's a big number. So $1 trillion market cap. I mean, he is sitting on, and this, by the way, there's debt too. So there's an offset here. But if you look down at this line, which is the enterprise value, if you deduct the enterprise value from the market capitalization, you end up with the net cash, effectively. So think about it this way. If a company carries a lot of debt, its enterprise value is going to be greater than the market capitalization. You deduct one from the other. And it's a back of the napkin method, and there's a little bit more to it. You obviously want to understand the credit side a little bit better and all the rest of it. But just as my quick thumb in the wind, then you're going to see whether you have net debt or net cash. And the short answer is he's carrying a lot of cash. I mean, a lot of it. $522 billion enterprise value, $1 trillion market capitalization. That's a lot of net cash. Why does he carry so much net cash? Well, one is that his businesses generate a lot of it. I mean, their principal business is insurance. They generate premiums, and usually they invest that. But the fact that they haven't been suggests that they just can't find that many attractive places to deploy it. So that's interesting. There is something else, too, which is that Warren Buffett has, and I think there can be regime changes to this, but he has often talked about the value of publicly traded equities relative to GDP. And we're getting right up there. I think we have again, round numbers, publicly traded equities at 50 trillion and GDP at 30. That's stretching it a bit. One of the things I don't really like about that as a barometer is that, we have these kind of super companies that are throwing off profitability relative to their revenues at levels that I don't think we've ever seen before. I mean, when General Motors was the darling, or when ExxonMobil was the darling, when industrial companies were the darling, and even when the biggest banks, were hitting it on all cylinders, basically, none of those companies ever generated profitability like what we're seeing from tech companies today relative to their revenues. And certainly relative to the number of employees that they have. That's the other thing, right? So they're just cash and income generating machines that is kind of unparalleled in history. And actually, as an example of that, we can think of, the first billionaire in the country was J.D. Rockefeller, who built Standard Oil. And when they broke up Standard Oil, Exxon is now the largest one of the spinoffs. And of course, some of them have gone back and gotten, have merged again. But if we go back in time and we just say, okay, well, let's just take a look at, some of the best years that this company has ever experienced. 2022, recently, very good year. Round numbers, $400 billion in revenues, $60 billion in net income. and that was probably the best one we can find. I'm just going to scroll through here. Well, let's see if we can see some pretty big numbers. The thing is, though, just take a look at the margin percentages that you're dealing with. And also just remember how big these companies are, right? So Exxon, 61,500 employees, and everybody uses and needs their product. And here, we see $400 billion in revenues, and their net income margin is a little less than 15%. Compare and contrast that with the kinds of margins that modern technology companies are generating. The forecast for NVIDIA is 56% for the full year ended January 31st, 25. That's the net income margin. That's after you've paid your taxes. Gross margins of 76%. Basically, they sell a product and, that's all profit. We haven't seen anything like that in history. When you make things, when you produce things, when you mine things, when you pump them out of the ground, when you grow them, it doesn't really matter. It's a much more labor-intensive process. You just don't get those kinds of margins. So my trouble with the Buffett indicators is that I don't know whether we can take as a guideline how we valued publicly traded equities between 1900 and 2000 and apply it to some of these modern businesses. And the interesting thing is, of course, it's all of the biggest ones. So I actually think that a better way to think about this would be to take a look at the index and extract all of those companies. If you took the top 10 companies from, say, the S&P out of the picture, and we know that several of them are multi-trillion-dollar businesses, that total value of publicly traded equities relative to GDP number begins to look a lot different, because you can throw 10 trillion of the 50, 20% of it out the window just by eliminating those 10 businesses. Is it right to do so? I'm not 100% sure, but it's just something I think we ought to be thinking about. Michael Richard, check your buys and sells. 3 calls, 1 put is not correct. No, that's definitely not. Oh, there we go. So there we have it. We're back on the screen. So we're looking at in this case, it's a $50 box. Let me just make sure that's right. So I'm buying, no. I'm supposed to buy that put. So there we are. There we go. So I'm buying the 525 calls, and I'm buying the 575 puts, and I'm selling the 525 puts and selling the 575 calls. So, yeah, thank you for doing that. And one thing also you'll quickly notice, clearly these prices are a little bit whacked. You can see that this is costing a little over $50, right? And why? So this is where things get a little bit tricky. So SPY does pay a dividend. So this is why we would never trade boxes in here. Just there's a lot of early exercise and assignment nonsense you have to keep track of, and it's not priced efficiently enough anyway. But a $500 box in SPX is going to trade at a discount to $500. It's a zero coupon bond. So you can imagine that if you have a 5% interest rate annually, and you're going to carry that box for a quarter of a year, then you're going to expect that box to trade at a discount of 1.25%. And again, this isn't compounding. I'm just saying, to keep the math simple, that's going to be a quick way to illustrate it. So that means it's going to trade, for about $4.94-ish, right, in that neighborhood, right? So you would buy the box, pay $4.94. And when this settles, because SPX just settles to cash, you will receive $500 in exchange. When else might you do something like this? I mean, if you were doing business with a broker that paid you terrible rates, but margined that thing appropriately, I guess I had somebody ask me about that. You could or if you were trying to speculate on rates and that was the only way you knew how to do it, I guess you could do that, right? If you thought that, if you thought rates were going to just plummet, you could, buy a box, or if you thought that they were going to go the other way, you could sell it. So you could speculate on it. Not necessarily what I would recommend, but that's what happens because SPX just settles to cash. It trades just like a zero coupon bond. And Eagle Eyes out here, Michael Richard, thank you for keeping your eye on that. Alex V says, hi Mike, for that delta neutral strategy you've mentioned that you'd prefer SPX over SPY, SPX is an index, can't trade it directly. What shares can be used to adjust delta on such a trade? Oh yeah, so great question. I still use SPY, by the way, to hedge the deltas. It's just remember that every SPX contract is give or take. It's effectively 10 times the size. So if you can imagine that, maybe we can work through an example. So I'm going to use SPX again. And so what I'm going to do is I'm actually going to pick a strangle that is not delta neutral, that goes out to, say, the end of September, and say this is what you would need to hedge it with using SPY. Okay? So let's imagine, for the sake of argument, that you had that's what I was just talking about. So maybe actually 50-50, so it's a little far out of the money. So let's go out. We'll go to the end of September. Go to that, please. It should. Why is, oh, whoops. There we are. And I'll just put in a bunch more strikes. Okay. So here we go. So let's imagine that you own the 50, yeah, we'll go with the 5,400 puts in SPX, all right? So let's say you've got 10 of those, all right? So 10 5,400 puts, those are 23 delta. So just put that number into your mind. And here we go. And 10 of the 5650 calls. Those are 40 delta. So we have net, you are net long 17 deltas effectively, times 10. So each SPX, one SPX synthetic is 100, it's 100 multiplier, right? So, and it's a $5,600 underlying. So if you had 10 of these strangles on, and this was 57 bucks, I don't remember what the other one was, and that's not terribly important. You need to buy 17 deltas. So if you're trying to translate that to a number of shares, that's going to be the equivalent, each one is 170 deltas of SPY. So every 17 deltas in SPX is 170 deltas of SPY times 10 is 1,700. So you would be long the 40 delta 5650 calls here, long those 5,400 puts, and you would be short 1,700 SPY against it. And these two trade in lockstep. Let's illustrate that. So you can see, you can trade futures if you are permission for futures, but you don't need to. And the beauty of it, by the way, this is important. If you have a customer portfolio margin account, these cross margin. So SPY trades around the clock, trades like water. A lot of people, I know people that, when I was trading prop and as an institutional trader, we always used to talk about the S. We would talk about the S&P. That was our market benchmark. But I've worked with other people in the business, portfolio managers, who run $1 billion, and they actually think about the market in terms of SPY. Right? So you don't need to think about it one way or the other. And I'm going to say that, most traders think about it in terms of some underlying index level. They often trade futures and stuff like that, but it doesn't really matter. But these things cross margin. So the important thing to remember is just that SPX contracts are 10 times the size of the SPY contract. So whatever your delta is, you have to multiply it by 10. If I had one of these things, it'd be 170 shares. If I have 10 of them, it's going to be 1,700 and so on. So you just calculate the delta and then just make sure you're using the appropriate multiplier. But the easy thing about it with SPX versus SPY is that it's not like the multiplier is different. The multiplier in both cases is 100. It's just that one is 560 bucks. I'm using this for illustrative purposes. There's a carry issue. But one's 560 and one's 5,600, right? So it's actually pretty easy to do it that way. And that's how you should. And that actually is how I usually do it, SPX versus SPY. Okay. Yes. And oh yeah, so Brad, you were mentioning you can trade futures on SPX. Yeah, I mean, some people aren't comfortable trading futures, or they aren't permissioned to trade futures. It's an interesting, you could, believe it or not, you can trade, if you were doing a lot, you can actually trade combos. But that isn't that great in the following sense, which is, so what's a combo? It's what I was just talking about. Buy a call, sell a put, that's a combo. It's basically the equivalent of a future or a forward or a round lot. The problem is that because it's a round lot, that would only work if you are going to hedge within, up to about 10 deltas if you're trading SPX and you were doing at least 10 lot. So what I mean by that is that if I was long those strangles, so I was net long 17 deltas per one lot, times 10 is 170 deltas. Well, that's 1.7 combos, right? And I realize this is probably getting into the deep end of the pool a little bit on this, because we're advancing from implied to realized to boxes and strangles, trading vol, and then hedging the deltas using a construction of options. But that's all it is. If I buy a call and sell the corresponding put of the same strike and expiration, that's basically just getting long a round lot. And if I do the opposite, I can do that. And that's something that other institutional traders will also do from time to time, but don't worry about it. Just trade SPY. It's the easiest thing. When is NVIDIA coming out? 7 minutes? Is that what we got? What? It's out? No. Oh yeah. Let's take a look. What's going on with the stock here? Where's my quote to? Down $5. So inside the implied move. So I guess we're gonna have to wait and see what they have on the call. I mean, I'm almost tempted to join it just to see. And by the way, I do kind of want to listen to that call. If any of you have not listened to an earnings call, I recommend it. And actually, I can get this on the Bloomberg, but I wanted to do it this way. So if you go to NVIDIA Investor, this is true in any case. So if you don't have a Bloomberg terminal, which I'm sure many do not, you can just go to the Investor Relations page and go to their events and presentations, and then you can just go to listen to the webcast, which is what I recommend. And that is going to begin in 6 minutes. What do you want to listen to if you decide to tune into that call, or any call? Listen to the questions that the first sort of slew of sell-side analysts are asking. And the reason to listen to that isn't necessarily because that's the single most important set of drivers for the company's success. The reason it's important, though, to me, is that I want to know what other analysts are looking at. What they're usually trying to do is, in their model, in their spreadsheet, they're trying to put in that magic number, which gives them a sense of where the stock price should be. So how many units do you think you're going to sell? What do margins look like? Those are the knobs that they're twisting in their model that at the end of the day spits out a price that becomes their price target. So over the course of time, if you are listening to a lot of these conference calls in the same company, so you hold a stock in your portfolio and you hold it for a lengthy period of time, you'll eventually sort of be tuned into the things that are likely to get everybody else on the street kind of worked up. And that just gets you a general sense of the things that you want to be thinking about, simply because you want to know how others are likely to respond. That is different than what you happen to think is going to be the biggest driver. That's something else. But the fact is that those are the little metrics that are likely going to matter this week, next week, and over the course of the next month or so when it comes to the price action. Long run, of course, it could be very different, because all of us investors struggle to make sure that we're looking at the right thing, the most important thing, all the time. Okay, so I wanted to make one quick announcement, because next week is Labor Day, and the market obviously is closed for Labor Day. People should probably be enjoying that weekend, so I'm not going to bore everybody with a live stream on Labor Day weekend, and I'm also not going to tie up the time and attention of the other people that are involved in putting this together, who are listening in right now, but hopefully they're nodding and are appreciative, because they'd probably rather be making hamburgers or something. But what I'm thinking I will do instead, if there's an interest in it, is doing one on Thursday instead. And maybe an intraday, I've mentioned a couple of times. So Thursday, next Thursday, not Thursday tomorrow. Tomorrow I'm actually going to be on CNBC Pro with Mike Santoli. So if anybody has CNBC Pro, you can tune in for that. I believe that's on my schedule. And I might also, am I on Fast Money this week? I might be on Fast on Friday. I don't remember quite offhand. But next week, we'll do the regular live stream. That's our plan for 4:15 on Wednesday. Mondays, my intention is to do that midday, if possible, on Thursday. So if that's of interest, please drop a comment, or if you have another suggestion on timing, can't promise that I can make it work. But let's take a look at that. And in addition, because this one's a little bit more fluid, if there's something in particular that you have an interest in that you would like to look at, news that we might be getting out between now and then, or news that's going to be coming out shortly thereafter that you would like to look ahead to, post a comment, and we'll try to incorporate that. And with that, I'm going to say, look, what's going to move the markets right now is this call, which starts now in 2 minutes. I'd like to listen to it. I'd recommend that some of you do as well. So we're going to cut this one off a little bit earlier than usual. And I'd like to thank all of you guys, as always, for tuning in. Like, subscribe, notification bell, all that good stuff. And we will see you next week. Thanks for watching.